Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Colleges are sending the first tuition bills in early August. Joining me to discuss is Christine Roberts, Head of Student Lending at Citizens. Christine, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
And Christine, there's a hierarchy when it comes to paying for college in the most affordable way, and stepping out of order can place financial strain on a family. What are some of the common mistakes payers make, and also give us some tips to better manage it?
Sure. First and foremost, everyone should fill out the FAFSA, even if you think you're not going to get anything from schools or from the government. A lot of schools use that as a way to determine free money also. So make sure, number one, that you fill out the FAFSA, and you can do that at any time. Typically, it's starting in October of your senior year, but even if your child's going to be a freshman, it's August, fill it out regardless. So that's first and foremost. Then obviously we tell everybody, exhaust all of the free money, right? Grants, scholarships, take any free money that you can possibly get your hands on. Additionally, with that, then we recommend that if families are still in need, to look at the Stafford loan for the student. It's a loan only in the student's name. Freshman year, it's $5,500. So it's I think a controllable amount. It starts your child's credit file. So I think that's really important, right? As we all know, you can't get credit unless you have credit. So building their credit file is important. It's also an extremely low interest rate from the federal government, held only in the student's name. It's a great way for them to build both skin in the game and responsibility with payments and lending as they go forward. And then it really becomes more personal choice. If there's availability of funds at the family level that they can, place cash down, that's great. But then they really should be comparing whether or not they want to go with a private lender or with the federal government. The federal government only has a Parent Plus loan, so it's in the parent's name only. It's a 10-year fixed rate, term, and it also has a 4.25% fee. But for families who don't have very strong credit files, it's a good option. On the other side, you have private lenders such as Citizens, where we have multiple terms, 5, 10, 15-year loans. You have fixed or variable interest only, full repayment, deferment. You can also borrow in the child's name with you as a co-signer, right? So again, you're adding to your child's credit file. You're loaning them your credit score. They have full responsibility for the debt, but you're there to be a safety net. So, as a family, you need to decide, do I, the parent, guardian, want to take on the debt completely myself, which would be the Parent Plus loan and or a parent loan from a private lender? Or do you want your child to have the loan and you be a co-signer to help them receive better interest rates?
Yes, and definitely take advantage of that free money. I just got my tuition reimbursement approved, and it is a huge help and a great way to pay forward for the next semester. Now, with loan repayments, they're resuming in September, and families need to assess their current financial situation and determine if they can afford to pay the loan faster or if it makes sense to consolidate or refinance loans. How will the year-long pause affect repayment timelines?
Yeah, so if you've made no payments during the past 17 months where everybody's been in forbearance, then what they will basically do, everybody will get their loans reamortized. But if you have not made a payment, for the most part, your payment's going to stay the same, right? So you can take a look at that. If you have made payments during that time, your loan will reamortize for whatever the remainder of your term is. So if you had 5 years left on your loan, you still have 5 years left, right? And your payment will change and obviously go down because all of the money that you would have paid in the past 17 months would go against the principal. So definitely, my feeling is for families, if you're concerned about resuming payments, I would call the servicer and speak to the servicer as soon as possible. We still don't know. There's a lot of back and forth in Washington as to whether or not payments will definitely resume. First of all, don't plan that they won't, but be prepared if they do, and talk to the servicer about options. So if you think you are going to struggle, there are options federally for you. They have income-driven repayment plans, there's hardship forbearance, etc. And so reach out, start those conversations early, because like any other industry, the servicers lowered their staffing levels because there wasn't a whole lot of need for them. And so they're in the process of building that up. And I think the sooner you understand the process for either joining an income-driven repayment plan or what the forbearances are, et cetera, the more smooth it will go for you should payments resume at the end of September.
The annual student lending survey shows that affordability concerns remain top of mind for students and families. What were some of the key findings that you saw?
Yeah, we're finding that about 70% of the folks that we surveyed are really concerned about the cost of attendance. They're seeing their bills increase on average year on year. They're expecting to spend more than $8,500, almost $9,000 more this year, right? And what a tough year to be adding, more funds into an expense. And so they're struggling with what their options are. And quite frankly, now with everything that's kind of coming about with vaccinations and no vaccinations, and families are still deciding whether or not attending school is the right thing for their child right now. Lots of kids got waitlisted. 30% of the students that we surveyed were waitlisted at like top schools of their choice. And so I think there's more uncertainty this year in a different way than what we had last year. I think people are just not sure what to do, whereas I think more families were more confident in their decisions as to whether or not they would be on campus or not, and how they would approach that. I think there's still a lot of angst right now, and how people will respond to that is still something to be seen.
So when you said they expect to add $8,500 to $9,000 in expense, was that just for school or overall expenses?
That's just for school.
So let me do the math here. If you go to a $50,000 a year school, which is a hefty budget, nearly $10,000, it's 20% added cost.
Yeah, I mean, the families that we surveyed are saying that that's what they're seeing. They're seeing an increase. Now, some of that could also be, right, a lot of schools last year didn't charge room and board. And so, there could be a little noise in that, but still, especially if you've got, a rising sophomore, right, you may not have planned for that additional expense. And so some people are getting a little sticker shock when they're getting their bill.
All right, Christine, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.